What's up, future millionaires? John here, and look, I know the stock market can seem like this big, scary thing, but trust me, it's not as complicated as you think. In fact, once you get the basics, it's actually pretty straightforward. That's why, in this video, we're breaking down the ABCs of investing, so even if you're starting with zero knowledge, you'll walk away feeling confident and ready to start growing your money. No more feeling like you're missing out or leaving your financial future in someone else's hands. We're talking about taking control, building wealth, and achieving your financial goals, one smart investment at a time. So grab your notebooks, buckle up, and let's get you started on your journey to becoming a stock market pro. Alright, let's start with the million-dollar question. What exactly are stocks? In a nutshell, stocks are like tiny pieces of ownership in a company. You become a shareholder. Think of it like buying a slice of your favorite pizza place, except instead of getting free pizza, you get the potential for profit. When a company like Apple, Tesla, or even your local coffee shop does well and makes money, guess what? You make money too. That's because as a shareholder, you're entitled to a portion of the company's profits. Now, how much money you make depends on how well the company does and how much of the company you own. But here's the exciting part. Stocks aren't just about sharing in the profits. They also represent a piece of the company's future potential. Think about it. If a company is developing a groundbreaking product or expanding into new markets, the value of your stock could go up, even if they're not making huge profits yet. Of course, like any investment, there's always a chance the company might not do so well. Maybe their new product flops or the economy takes a downturn. In those cases, the value of your stock could go down. And yeah, that's the risk part of the equation. But remember, we're in this for the long haul, and over time, the stock market has historically trended upwards. So, by investing in companies you believe in and holding on to those investments for the long term, you're giving yourself the best chance to ride out those ups and downs and come out on top. And that, my friends, is the beauty of the stock market. It's about owning a piece of something bigger than yourself, participating in innovation, and building wealth over time. It's not about getting rich quick. It's about making smart decisions, staying informed, and watching your money grow steadily over the years. So, you're probably thinking, okay, John, this all sounds great, but how do I actually buy stocks? Well, my friend, it's easier than you think. The first thing you need is a brokerage account. Think of this as your gateway to the stock market, your own personal stock shopping cart. Now, there are tons of brokerage accounts out there, each with its own pros and cons. Some popular options are Robinhood, Fidelity, and E*TRADE. Personally, I like to shop around and compare fees, features, and user experience before choosing a brokerage account. Once you've picked your brokerage and opened your account, which usually just involves filling out some basic information online, you're ready to fund it. You can link your bank account or debit card to your brokerage account and transfer money in just a few clicks. Now comes the exciting part, buying your first stock. Most brokerage platforms have a search bar where you can type in the name or ticker symbol of the company you want to invest in. Let's say you're a big fan of Apple products and believe in their future. You'd simply type in AAPL, which is Apple's ticker symbol. Once you've found the stock you want, you'll need to decide how many shares you want to buy. A share represents a single unit of ownership in the company. Remember, you don't need to buy a ton of shares to get started. Start small, invest what you can afford to lose, and focus on building your portfolio gradually over time. After you've entered the number of shares you want, you'll place your order. You can choose a market order, which buys the stock at the current market price, or a limit order, which only buys the stock if it reaches a certain price you set. And that's it, you've officially bought your first stock. See, I told you it was easier than you thought. Now, before you go all in on your favorite meme stock, let's talk about the different types of stocks and how to build a diversified portfolio. Alright, now that you know how to buy stocks, let's talk about the different flavors you can choose from. Because just like ice cream, the stock market comes in a variety of options to satisfy every investor's taste. First up, we've got growth stocks. These are like the hot new startups of the stock market, the companies with the potential to skyrocket in value. Think Tesla, Square, or any company that's disrupting an industry or creating a brand new market. Growth stocks are all about innovation, expansion, and pushing the boundaries. They're exciting, they're volatile, and they have the potential to generate some serious returns. But remember, with great potential comes great risk. Growth stocks can be more volatile, meaning their prices can fluctuate more dramatically than other types of stocks. Next, we have dividend stocks, the reliable old friend of the stock market. These are the companies that have been around for a while, they're well established, and they like to share their profits with their investors in the form of dividends. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. These companies are like the bedrock of the stock market. They're not going to make you rich overnight, but they offer stability, consistency, and a steady stream of passive income in the form of dividends. Finally, we have index funds, the diversified superheroes of the stock market. Index funds are like baskets of stocks that track a specific market index, like the S&P 500 or the Nasdaq 100. Instead of buying individual stocks, you're buying a tiny piece of hundreds of companies at once. This diversification is key because it spreads your risk across multiple industries and companies, reducing the impact of any single stock on your overall portfolio. Index funds are like the set-it-and-forget-it option of the stock market, perfect for long-term investors who want to build wealth gradually over time. So, which type of stock is right for you? Well, that depends on your risk tolerance, your investment goals, and your time horizon. If you're young, have a higher risk tolerance, and are investing for the long term, you might consider allocating a larger portion of your portfolio to growth stocks. If you're closer to retirement, have a lower risk tolerance, and are looking for more stable income, you might want to focus more on dividend stocks or index funds. The key is to find the right balance for your individual needs and goals. Now, before you go all in on any one stock or investment strategy, let's talk about risk management. Because here's the thing, investing in the stock market always comes with some level of risk. The market can be unpredictable, companies can fail, and even the most experienced investors can lose money. But here's the good news. There are steps you can take to minimize your risk and protect your hard-earned money. The first rule of risk management is diversification. Don't put all your eggs in one basket, or in this case, all your money in one stock. Instead, spread your investments across different companies, industries, and asset classes. Think of it like this. If you invest all your money in a single restaurant and that restaurant closes down, you lose everything. But if you invest in a basket of restaurants, even if one or two fail, you still have the others to cushion the blow. The second rule of risk management is to have a long-term investment strategy. Don't try to time the market or chase short-term gains. The stock market is a marathon, not a sprint. It's natural to feel tempted to buy when the market is going up and sell when it's going down. But this emotional roller coaster can lead to costly mistakes. Instead, focus on the long game. Invest consistently over time, ride out the market's ups and downs, and let the power of compound interest work its magic. The third rule of risk management is to do your research and invest in what you understand. Don't invest in something just because everyone else is doing it, or because you heard it was a hot stock. Take the time to learn about the companies you're investing in, understand their business models, and evaluate their growth potential. Knowledge is power, and the more you know about your investments, the better equipped you'll be to make informed decisions. Finally, remember that investing in the stock market is a journey, not a destination. There will be ups and downs, wins and losses. The key is to stay informed, stay disciplined, and never stop learning. The more you educate yourself about the stock market, the more confident and empowered you'll become as an investor. So, embrace the journey, enjoy the ride, and never underestimate the power of long-term, consistent investing. So there you have it, the basics of investing in the stock market. Remember, it's not about getting rich quick, it's about making smart decisions that will help you build wealth over time. Start with low-cost index funds, invest consistently, and let compound interest grow your wealth over time. The earlier you start, the more time your money has to grow. So what are you waiting for? Thanks for watching, and happy investing!